Welcome back, everybody. Hope you have had a good, blessed Monday. Today, I want to talk about the consequent encroachment, mean threshold model idea that we talked about in the live stream. I want to go over a couple examples of how this model can be used with different PD arrays. And there are one or two exceptions where this model will not be applicable. And those PD arrays are going to be the volume imbalance as well as the institutional order flow entry drill, which is a small fair value gap, and price usually tends to tap into the opening or the low of that fair value gap and then trade down lower. So you would not expect price to trade into the consequent encroachment of that particular gap. To start things off, let's first take a look at a basic checklist that I made. If you have not yet taken a look at the previous video I made about the Notion template, it's a good idea to look at that video before you reference this one, as that video will give you additional checkpoints and you can take what you learn in this video and you can apply some of these checklist checkpoints with those, and you can add on top of that, giving you, in my opinion, a very good base foundation with a good set of checklist rules to get you started out of the gate. And then, of course, with time and with experience, you can add, change, or remove more criteria to this checklist. You are now looking at the checklist. So first off, we have what's on the calendar. This would just be you glancing at the calendar, looking what would be on the calendar. Is there any high impact news events? And do those coincide with the specific time that you would like to take that trade on? We then have higher time frame bullish or bearish. This is just directional bias, which can be obtained from the higher time frame. That could, of course, be the daily, or that could be something like a 4-hour chart, depending on what you use. Then we have a clear draw on liquidity on the higher time frame. That would price be, for instance, reaching for a equal low, or would price be reaching back for an inefficiency? Then you have your lower time frame checklist, which would be macro. What specific macro time with the setup that you expect to see or anticipate be falling into? Have the stops been taken out? Have we gotten a market structure shift? Did you have an impulse move? And lastly, do you have a clear draw on liquidity? Now, let's work through this checklist and add some variables to this checklist. Now, again, this is something that with time and with more experience, you will change, add, or remove things to this checklist to make this checklist your own. But this is a good foundation for any starting or new trader. This is a good, solid foundation to get started. What is on the calendar? If, for instance, we have something like NFP, then obviously you would not be looking to trade NFP. So, right off the bat, that would be one of your rules that you would not be trading NFP. So, if you have NFP on the calendar, then you stop there and you do not continue on. You do not trade on a pre NFP day usually. If, for instance, you step into the market and we have something like FOMC, typically on let's say, a Wednesday morning, and it falls, you have FOMC at 2 p.m. that specific afternoon. So obviously, you would have to stop in your tracks and then you would not be taking a trade for that particular AM session, which that would be low probability. So that would be your first filter. And that reminds you to go take a look at the calendar, get you into that habit. And if you have FOMC, NFP, or CPI as a general rule, then you would not be trading those. So then you would not be looking to take a position before that news event. You would wait for that news event to surpass, and you would then look for a trading setup. Higher time frame, bullish or bearish. So here you would be looking for higher time frame to be bullish or bearish. Now, something that you could add here could be that the higher time frame could be sitting inside of a consolidation, which then obviously you would be looking to trade intraday and scalp session liquidity, of course. So that could be a determining factor whether you are going to be looking to take a trade and hold that position for AM, or if you would just be scalping as there would be no clear direction when the higher time frame would be inside of a consolidation. Clear draw on liquidity on the higher time frame. Again, if you do not have a clear draw on liquidity on the higher time frame, which would then mean that you would be inside of a consolidation, you would then look to trade intra-session liquidity once again. We did then drop down to your lower time frame or execution time frame checklist. You would then have to look if you were inside of a macro. If not, then of course that is where you stop and you do not execute on that setup. So this gives you a hard set of rules that you can implement. So let's go into the charts and let's take a look at how we can implement some of these rules on the consequent encroachment or mean threshold entry model. So here we are looking at the US 100 on a daily chart. We have opened up the week with a gap, gapped down to this old low here. And we have been trading back up into this range. We can clearly see this if we drop into a 15. We have this new week opening gap here. We opened up a lower, tapped that old daily low, traded down, and then traded back up late in the day, coming back up into this new week opening gap here, essentially. Classic day where we open up, we trade down lower through the Asian session, and we then rally up higher to go back into this new week opening gap here during the AM session, as well as late as lunch. Then retracing back into this order block, and then finally giving one small little push back up here before we market closes, and then continuing to dribble up higher. So if we look at this daily chart, we would expect a clear bearish move down lower into this old low. And that lines up with the seasonal tendency that we have with expecting bearish price action. So on a higher time frame, that would very clearly be a bearish scenario. For this example, we are not going to be looking at Monday's price action. I will be working off of Friday's price action. And for Friday on the calendar, we were looking at 8:30 average hourly earnings, and we had non-farm payroll and the unemployment rate coupled with that. So that would be a perfect example of NFP at 8:30. So I'm not able to take any trades. Prior to that, I would have to look at taking something after the fact. So that would hold me back from taking anything prior to 8:30 or on 8:30. So let's go back to Friday, and we're not able to take anything prior to 8:30, and most likely you will be waiting for the first 30 minutes. Give 30 minutes after that for that to pan out. Let the market do what it wants to do here. We had this gap. The market ended up trading back into this gap, and then finally tanking down. So you would ideally, in a perfect scenario, would be waiting for 9:30 opening. So on a hard time frame, we would of course then be bearish. Would we have a clear draw on liquidity? Yes, we would. We would be looking at that old low and for price to reach into that. So as a first example here, we have price clear out these old lows here, and we had these marked up on the stream. Go back. Go back. Here we go. There's that rally down, reaching for that old daily low. We had that daily fair value gap here above us. And we had these equal highs here marked. So 50-minute equal highs. Get this to snap back. Just extend this over. Okay. So here we go. We would then be inside of the, this would be the 920 up to the 930 macro here. tapping into that, rallying down. Now, in this case here, I will be looking at this fair value gap here. That is a nice fair value gap setup. We have this inversion. We have that there. Price in this case sat inside of it there, not something that I would be looking to take a trade off of. I like to see price trade through this and then tap back into it like this and then rally off. That would not be applicable to us as price did not trade into the consequent encroachment here. But that we use this as a base. So we have that inversion, and if price trades into that, then that is an extra confirmation or an extra confluence that we have sitting above us. I primarily want to focus on this fair value gap here, and we will change the color of this one to green so that it stands out. And in this case here, we have these equal lows as well as these relative equal lows here that we would use as a target. Now, first things first, the stops were taken. Yes, they were. We traded 15-minute equal highs. We are bearish on a higher time frame, so we would be ideally be looking to trade in line with that idea on a lower time frame. So the stops were taken. Did we have a market structure shift? We have a low here. Price traded through that low, and we have done so with a big impulse candle. Now, we could also use this inversion with price with trading through this below this inversion with this same candle here, and that also gives us a confirmation that price has shifted structure. By looking at price, anticipating that price gives us a inversion with this fair value gap. Did we have an impulse move? Yes, we did. We traded below this short-term low here, and we have traded through that inversion with a big bold down candle. Do we have a clear draw on liquidity? Now, don't get confused over here. We have a clear draw on liquidity on the higher time frame, but this draw on liquidity is going to be the draw on liquidity that you anticipate price to trade to on your lower time frame. That could be something on the 15, the 5, the 1 minute, or even the hourly chart where you see something here and you anticipate price to go to that target and trade to that level. So you do need to have a clear draw on liquidity before you can take any setup here. So don't get confused between the two here. So the draw on liquidity here would be we have relative equal lows here. And I'm going to make these in blue. Relative equal lows. And we have more relative equal lows below those. So those would be our targets. And we would be looking for price to reach to those. So if we go through the checklist, everything checks out on the checklist. Nothing on the checklist so far would be a red flag or would be going against what I would be looking for on that checklist. So that would be a viable setup if time of day lines up with that setup, which macro 950. So 950, beautiful. It hits exactly in that 950 to 1010 macro short position. Now, for this to be viable for us, we would look for price to trade into the fair value gap, consequent encroachment. So that'll be the mean threshold. Price traded into that mean threshold, traded up into the inversion low, rejected and closed below the fair value gap, consequent encroachment. So when it rejects like this and it closed below that, you could take an entry in there. And for the stop, above the inversion. Why above the inversion? Because you would have a fair value gap, inversion, as well as the order block sitting here. So 3 PD arrays. That's how I like to manage my position. You might take your stop at a different level. That's all up to you. So we would have that stop up there, and then we would be looking for the normal 5 handles, which that would be right there. Massive stops here, by the way. It's the market has been running really, really big ranges. Yesterday, we saw the same thing coming to fruition in the AM session. But anyway, you would be looking for 5 handles, and then you would be looking for 10 handles, something like that there. Now, depending on how many handles you were looking for, price does not have to trade into the relative equal low for you to make a profit. This is just the draw on liquidity. This is your draw for that specific macro. You're expecting 950 to everything is in play here for price to draw down lower. So you look to make your 5 handles or your 10 handles, or if you're looking for your 20 handles, then you look for that. If you're looking for 1 to 1, then you get 1 to 1 and you're out of that position. If you're looking for 1 to 2, then 1 to 2 would be here and you would be out of the trade there. So price does not have to trade into the target for you to be profitable. You have this beautiful fair value gap here, which would be a balanced price range because you have another fair value gap overlapping that. And you can look to take something off in that as well. So there are multiple ways to take partials in the market. It doesn't have to be a 1 to 1 or a 1 to 2 or a 5 handle or a 10 handle or a 20 handle. You could be looking for signatures like fair value gaps or balanced price ranges or different PD arrays on the left side of the curve, and you could be looking to take something off inside of those levels. Or you could even go and you could look for PD arrays on the left side of the chart. And you could also be looking to couple that with, let's say, 10 handles or 5 handles. And you look for PD arrays in close proximity to those 10 handles or those 5 handle targets. And that would be where you would optimize your entries, your exits, not your entries. Look to optimize your exits to get a good exit out of the marketplace. So that would be how you would use consequent encroachment entry with a classic fair value gap. All right, let's now take a look at how you would utilize this same setup with an order block. So we already have everything in play. Equal highs are taken out. We already had the stops taken. We had the market structure shift. We had the impulse move. We have a clear draw on liquidity still. The target has not yet been hit. So if we could find another entry inside of this price action, and if there is still enough meat on the bone, then we could still look to take another entry and we could still profit on that position. So let's take a look here. If we were sitting somewhere as an example here and we look at the low, there is still 23% before we touch into the low. And then we still have these lower equal lows here, which we still have 44% left on the bone. So we still have about 20 handles here sitting on the bone, and we can still profit off of that. So with that idea still in mind, we can then look for a potential entry to take another position. One more thing we could do here is we could take the fib, take it from the high, pull it to the target. You have your expected range here. And in this case, we would be looking at these two up close candles as the potential order block. Again, I'm making them green so that this is our focus point. So we have these two up close candles here. We would then be expecting price to trade to the mean threshold of these up close candles, and that just happens to coincide with the 50% of this expected trading range over here. So you mean that would mean that you still would be able to take a position as we are still in a premium here. So let's remove this from the chart so we can get a better look at this setup over here. So with this setup, we have this inversion as well as this fair value gap here, as well as this inversion to the left. If you pull that over, that would be another balanced price range. So you've got all that backing you up with this setup. So price 955 taps into the mean threshold of this order block. The order block gets confirmed in this candle where we trade and close below these two up close candles. That would be a valid order block. Thus, we trade into them over here, which that would not be applicable to us as it did not trade into the mean threshold. We then come back into that order block at 9:55. That is still inside of the macro. If we get a rejection, which we do have a rejection with a close below the low of this order block, we could then take an entry anywhere inside of this area. The stop here, we have the order block. We have a very, very small fair value gap in here. And we have the inversion as well as fair value gap above us. So the stop would be right in that area over there. We then trade down lower. You get about 10 handles here. It's a good place to take a partial. Also lines up with this balanced price range, fair value gap. Lines up with the low of that. So that's a good place to just take something off, pay yourself something. We then do trade into that order block low one more time, which again, that would not be applicable to us as we did not trade back into the consequent encroachment of this. So that would be a potential partial point, or you could close the position off. If not, and you want to hold for this low or this one, there would still be plenty of meat on the bone. A nice hefty 20 handles here. Although you would have to sit through some consolidation to get that 20 handles. If you were targeting these lows, then that target was hit as well. So that would not be a bad run. All right, the breaker block example, here we go. So we have a high, low, and a higher high over here. These down close candles here would act as the breaker block. And more specifically, we would be focusing on this last down close candle here. We take this last down close candle, we extend that through in time. We come to this setup over here. We have some equal highs sitting here. Note that we also did take out these 15-minute equal highs. So again, going over the checklist, what's on the calendar? On Friday after the NFP at 8:30, there would be nothing on the calendar. So that's good to go. We would still be bearish. Clear drawn liquidity still in place. Macro 1050. So that would still be a nice macro to take a trade inside of the silver bullet. We would then stops have been taken up here, but they also have been taken here in the form of short-term equal highs. We also traded into these, notice, fair value gaps here that we have filled in. We had a nice impulse move here, validating that breaker block. So the impulse move was present. The market structure shift was also present as we cleared these lows. So market structure shift would still be a check. Do we have a clear draw on liquidity? Yes, we do. We still have relative equal lows in that area here. We just extend that through here. We have relative equal lows here, and we have this old low right there. These are relative equal lows here. So you could just extend those as your targets, use them as your targets. Relative equal lows here. So for this one here, we will look at the short. As soon as we trade into this breaker block, you wait for price to reach up into consequent encroachment or the main threshold of the breaker block. Price does so right there. Just misses it by barely a tick. So this is a scenario that I would view this as a valid scenario because we have missed it by one tick here. So that's close enough for comfort. So anywhere in there could be an entry. Take an entry on the next candle if you want to wait. See if price does in fact want to rally down lower. Entry could be taken in there. Overlaps with a fair value gap. We have two up close candles here. That would be the order block. The stop could be at that order block there. That would be a safe stop here. We also have this balanced price range overlapping with that level as well. So that is a relatively safe stop. Again, here you could go for a 1-to-1 on this. You could be looking to take a target at this fair value gap right there. You could be looking for a 1-to-2, which that would be below the low. 1-to-2. There's your 1-to-2. And that's pretty much all that it gives here. Then we end up pulling back and we end up going sideways here for a lunge. So we've covered quite a few PD arrays here. We took a look at the order block, the breaker block, the fair value gap. Again, as a reminder, the volume imbalance as well as institutional order flow entry drills. You would not expect price to trade into the mean threshold of those or consequent encroachments. So you would not be applying this model to those PD arrays. Hopefully you have brought your notepad and you've taken some notes. I've not yet seen anybody else going over the taking the mean threshold as a specific model or consequent encroachments. Everybody uses fair value gaps, order blocks, breaker blocks, as well as inversions. But I have not seen one YouTuber out there make a specific model on taking the entry off of the mean threshold or the consequent encroachment. Everybody's been watching them on the charts and having them on there, but nobody's specifically had that criteria where price has to tap that consequent encroachment or that mean threshold for you to get a valid entry point. So hopefully you have found this one insightful. Hopefully you have learned a couple of things. We will have a live stream this week on we're going to do a live stream on Wednesday, and we will sit down. We'll sit down at we'll open it up at 8:15 so we can just go over the levels, and then we can carry it on to the 9:40. We don't have much news on the calendar as for this week. And price ranges have been quite big as well. So, not much to anticipate, but these are the perfect environments to study in. So, hopefully, you have found this one insightful. And until the next one, good luck and stay safe.